Ever wonder, can you really earn income from real estate without buying physical buildings? Today, we're looking at 7 REITs that many investors are researching for 2026 and how real estate income works, even if you don't personally own the property. Welcome back to the channel. I'm Doug, the Retirement Guy, covering all of these monthly ETFs and income strategies. And in today's video, we're breaking down what REITs are, how they work, and explain REITs that many investors discuss when looking at different sectors of real estate. Let's dive in. Notice to all viewers, past performance doesn't guarantee future results. The information in this video is for educational and informational purposes only. It should not be considered financial advice, investment, tax, or legal advice. Always contact a licensed financial before making any investment decisions. So why REITs in 2026? There's a lot happening in the broader economic landscape. Historically, REITs performance has often shown sensitivity to interest rates. Higher interest rates have sometimes been associated with weaker performance in parts of the REIT sector, while lower interest rates can reduce borrowing costs and may support REIT evaluations. Some analysts expect the monetary policy shifts over the next 1 to 2 years, and investors are simply watching how these potential changes may impact the real estate related assets. None of this is guaranteed. It's just part of the market decisions. So, 2 general approaches to REIT investing. Strategy number 1 is diversified REIT ETFs. This approach provides a broad exposure across the real estate sector and spreads risk across many REITs. The benefits is the broad market coverage, the exposure to multiple property types, the reduced single company risk, and often appealing for beginners and long-term investors. The examples we'll discuss today, which will be Vanguard Real Estate ETF, VNQ, and the Charles Schwab US REIT ETF, SCHH. The second strategy is buying individual REITs. REITs come in many different categories, from warehousing to residential to data centers, storage towers, retail, and more. It allows investors to research specific sectors based on their goals and interests. There are several widely discussed REITs across different segments that we'll talk to today. Let's get into the REIT comparisons though. First one, the Vanguard Real Estate ETF. VNQ's highlights gives you a yield around 3.9%, and that's of course always subject to change. The broad coverage of a REIT and other related companies. It includes exposure to cell towers and data centers, and it has a slightly higher volatility due to the broader exposure. Now, the Charles Schwab highlights has a yield around 3.6, which is always subject to change again, but it focuses exclusively on equity REITs. So it's a more traditional property exposure, which is basically residential, industrial, and retail paying attention. So these are just REITs that you're buying that they make all the decisions. They pick what they want in the portfolio. Now, the individual REIT approach. And like I said before, REITs come in many different categories. Those warehousings, rental homes, residential, data centers, cell towers. There's so much more, almost that you could pick a category and they'll have a REIT for it. There are several widely discussed REITs that we'll talk about today. And the very first one is going to be Digital Realtor Trust, DLR. This operates like 300 plus data centers globally. They give you that yield of 3.9 to 3.1%. It supports the cloud computing, the AI workloads, and the internet infrastructure. Major clients include Amazon, Microsoft, Google, Oracle. Long-term demand for data, cloud, and AI continues to be a major theme. Now, we get into a different one, Vici Properties, which is the casino and resorts. It owns landmarks like Las Vegas Properties, Caesars Palace, MGM Grand, the Venetian, Mandalay Bay. Now, this yields a little bit higher, 5.8 to 6.1% yield. It uses a triple net lease model, which is the tenants cover the taxes, the insurance, and the maintenance. Many of these leases include annual rent escalations of often 2 to 3%. Average lease terms often exceed 40 years. And historically strong rent collection even in challenging markets. That's what makes Vici Properties the very interesting REIT. Now, Realtor Income Corporation, or O. It's a monthly dividend REIT. Known as the consistent monthly dividends for decades, it pays a yield of 5.5 to 6%. The tenants include Dollar General, Walmart, FedEx, Walgreens, 7-Eleven, Home Depot. Its high occupancy rate, which is historically around 98% plus, it focuses on essential retail and logical properties. Example performance snapshots showed around 7.8% yield to date or year-to-date growth in one period. And analysts give this a range of a possible future price estimates, not guaranteed, of going up. Number 4, Prologis, PLD. It's the industrial warehouse. You can see how we have, resorts, and then we have retail. Now we're talking warehousing. It's the largest industrial and logistics REIT in the world. That pays a 3.6 to 3.8, over 1.2 billion square feet of warehouse space. The benefits from e-commerce supply chain upgrades and automated distributions. And yes, major clients would include Amazon, FedEx, and Home Depot. The example is the year-to-date growth snapshot of up 21.6%. The analyst forecasts show a broad potential range, but not predictions. It's what the analysts have given. Now, Iron Mountain. It's a storage and data management. The yield, around 3%. It provides physical and digital document storage. High switching costs and regulatory compliance requirements. And long client relationships, often with Fortune 1000 companies. Major clients are banks, hospital, law firms, government organizations. Consider one of the defensive due to the essential nature of the document retention. So they're storing the documentations for the major industries, the banks, the hospitals, the government. So the key factors investors often evaluate is whether researching ETFs or individual REITs. Many investors look at these items: the stability of cash flow, the inflation protection through lease structures, growth potential in various property sectors, long-term demand trends, recession resilience of the tenant base, and occupancy rates and lease terms. The conclusion of all this is simple. The current market environment has led many people to research real estate-related investments as they evaluate diversification, stability, and long-term potential. And today's video reviewed 2 different approaches to REIT exposure, the ETF side or the individual REITs. how the different sectors, casino, data centers, industrial warehouses, retail, storage, the function in the REIT universe. Why analysts review real estate as an area worth watching in the upcoming years. And as always, this is not financial advice. This is just for educational breakdown of how REITs operate and what focuses they use. So tell me, give me a comment. Leave a comment down below. Love to hear from you. What do you think of REITs? Are they something to put in a portfolio? I know they won't be 100% of your portfolio, but is it something like I personally use? About 10% of my investments are in REITs? Let me know your opinion.
Thank you for watching. Press the like